Whether you are looking at the cryptocurrency, stocks, real estate, or any other assets, you'll often see the markets described in one of these two ways, as a bull market or a bear market. To put it simply, a bull market is a rising market, while a bear market is a declining one. Because markets often experience day-to-day or even moment-to-moment volatility, bull turns are generally reserved for longer periods of mostly upwards or downwards movements. Hi, my name is Gio, hope you're doing well. In today's episode, let's look closely at cryptocurrency cycles and few ways to survive during a bear market. Let's get right into it. So what is a bull market? A bull market or a bull run is defined as a period where the majority of investors are buying, demands exceed supply, market confidence is at a high, and prices are rising. If in a given market you see prices quickly trending upwards, this could be a sign that the majority of investors are becoming optimistic or bullish about the price increasing further, and may mean that you are looking at the start of the bull market. Investors who believe that prices will increase over time are known as bulls. As investors' confidence rises, positive feedback appear, which tend to draw in further investment, causing prices to continue to rise. Because the price of a given cryptocurrency is substantially influenced by the public confidence in that asset, a strategy some investors use is to try to determine investors' optimism in a given market, a measure known as the market sentiment. What marks the end of the bull market? Even during a bull market, there will be fluctuation, dips, and corrections along the way. It can be easy to misunderstand short-term downturns movements as the end of the bull market. This is why it's important to consider any potential signs of a trend reversal from a larger perspective, looking at the price action over a longer time frame. Investors with a shorter time frame often talk about buying the dip. History has shown that bull markets don't last forever, and at some point, investors' confidence will begin to decline. This could be triggered by anything from a bad news like critical legislation to unexpected events like the COVID-19 pandemic. A rapid decline in price can begin a bear market where more and more investors believe prices will continue to fall, causing a downward trend as they sell to prevent further losses. What is a bear market? Bear markets are defined as a period where supply is greater than demand, confidence is low, and prices are falling. Pessimistic investors who believe prices will continue to fall are therefore referred to as bears. Bear market can be difficult to trade in, particularly for unexperienced traders. It's really difficult to predict when the bear market might end and when the bottom price has been reached, as reversing is usually a slow and unpredictable process that can be influenced by many external factors such as economic growth, investor psychology, and world news or events. But they also can present opportunities. After all, if your investment strategy is longer term, buying during a bear market can pay off when the cycle reverses itself. Investors with shorter term strategies can also be on the lookout for temporary price spikes or corrections. And for more advanced investors, there are strategies like short selling, which is a way of betting that an asset will decline in price. Another strategy many crypto investors apply is dollar cost averaging, in which you have invested a set amount of money, let's say $50 every week or month, whether the asset is rising or falling. This distributes your risk and allows you to invest through bull and bear markets. Bull versus bear market. In simple terms, a lot of investors are willing to buy during a bull market while few are willing to sell. The demand became higher than the supply and the price starts increasing. In contrast, bear markets begin when investors are low in confidence and start believing that prices will continue to fall. A few factors to note to better understand the bull versus bear market. While some investors can be bearish, the majority of investors are generally fundamentally bullish. Most asset classes, including digital assets, typically post a positive return on investment if you are holding for long term. Between the two, a bear market is more difficult to invest in because many assets rapidly decrease in value and prices tend to become much more volatile. Investor psychology plays a big role in determining whether a market is bullish or bearish. However, that's not the only factor. Supply and demand, economic stability, as well as activities in the financial market also play a key role in making the market oscillate between the one way or another. Top 6 ways to survive a crypto bear market. Number 1. Stay calm and invest your time in research. Whether you see the bear market as an opportunity to buy the dip or find falling crypto prices a bit too stressful to handle, always try to keep calm and analyze the situation objectively. Emotional decisions are the ones that you will most likely regret down the road. While thinking about how to invest in a bear market, we usually focus on the prices dipping. You should use this time to research. Invest your valuable time in learning about anyone's cryptocurrency or many cryptocurrencies. The result will surprise you. You can also learn about crypto investment as your passive income source. Even if the prices fall, you can be hopeful that your crypto assets are earning returns of over 5% annually. If you have a proportion of reserve cryptocurrency, it contributes to network security and steady returns payment. As an investor, you must be proactive in knowing about the crypto market's changes and trends. You should also be competent enough to be able to face all upcoming challenges in the crypto trade. Always rely on credible sources and track the market regularly. It is the best way to secure your crypto investment. Number 2. Don't try to time the bottom, instead use the dollar cost averaging strategy. Nobody, absolutely nobody, can actually predict the bottom. You could study technical and fundamental analysis all you want or listen to experts, but at the end of the day, you may still have to rely on your gut feeling while trying to time the bottom. And as you will probably agree, gut feelings are not much of an option if you're looking for strategy to survive a crypto bear market. One of the most successful investment strategy during the bear market is the dollar cost averaging. It means you divide your reserve funds and trade with them in the future. I have a dedicated video for that right here. An example is, suppose you have $2,000 in your savings. You can break up this reserve amount into 5 trades of $400 or 10 trades of $200. You can trade using this smaller amount and stay safer. Number 3. Don't be anxious about selling. It is not easy to manage your emotions during a bear market. You desperately want to reduce your losses when you see a huge dip in price, but doing so will not earn any profit in the long run. You should relax and think about why you invested in crypto in the first place. You are looking forward to improve your life by earning more and doing more saving. You can make a huge difference in profits by effective planning. Earning profits is also a hard thing to master. You can get affected by greed and your expectation may rise to higher levels. It increases your trade risk primarily when you don't set a stop losses. Analyze why prices have fallen, dig deeper into the reasons, and develop your own solution. Rethink your strategy for a big gain. Number 4. Consider staking. When times get tough in a crypto bear market and your portfolio starts losing value, staking comes up as a good way to earn a passive income from your crypto stash. Staking basically refers to the practice of locking away your coins on a proof-of-stake blockchain for a while and being rewarded for it. The best part about staking is that increase the size of your wallet even in a bear market. That way, when the bull market resumes, you start with more than you had previously. Besides, staking also lowers the possibility of panic selling because your funds is securely locked on a blockchain. Number 5. Avoid shorting in a crypto bear market. Shorting is a technique traders use to profit from falling crypto prices. That should ideally make it in an excellent fit in a bear market when prices drops are a common occurrence. However, you will find that most experts advise against shorting Bitcoin and other cryptocurrencies because it could potentially lead to unlimited losses or liquidation of your position. This is a fundamental problem with shorting, and no amount of experience can prepare you when things go bad. When you buy crypto, which means you go long, you can never really lose more than the amount you have invested in. For example, say you have purchased Bitcoin worth $100. So the maximum you could lose from that investment is $100. On the other hand, the potential gain, at least on paper, could be limitless. Think of a scenario when the Bitcoin price increased so much that the $100 investment returns $500, $1,000, $10,000, and so on. It's just the opposite with shorting. If you short a coin at $100, the maximum you will earn from that trade is $100. And if you short using margin, you will have to keep paying the interest charge on top of the original loss for as long as you choose to keep the position open. And number 6, diversify your investment across different crypto assets and avoid leaving your crypto on exchanges. There happen to be over 17,000 cryptocurrencies on the market. No one can actually predict which of the cryptocurrencies will recover sooner or rank highest. It is also hard to predict how long the crypto bear market will last. You can use dollar cost averaging for a variety of different crypto assets. You might have to reduce your trade size, which will also reduce the overall risk for your business. It is not recommended that you select any cryptocurrency and invest in it. You will spend enough time learning which one will work best for you. Like they say, not your key, not your coin. This is applicable in pretty much any scenario involving a centralized custodial crypto exchange. However, the risk of losing your funds stored in these exchanges became even bigger during a turbulent bear market. Always opt for a non-custodial wallet app, or better still, a tried and tested hardware wallet to have full control over your crypto stash. The bottom line is, bear markets are not fun, but they are part of investing. It doesn't help that there are a lot of unknown about what will happen next on the roller coaster ride that is a cryptocurrency investing. Ultimately, the best way to survive is to only invest money you can afford to lose and ensure crypto only makes a smaller portion of your portfolio. That way, even a complete market crash won't affect your finances. However, based on the data from previous bear market, it is safe to say that Bitcoin always bounced back. So, the vast majority of experts and industry insiders are of the view that the best way to survive a Bitcoin and other altcoins bear market is to hold and patiently wait out the storm. Having a long-term outlook is essential. Furthermore, try to avoid trading when the market is in a bearish phase, especially if you have little to no prior exposure to trading. Thank you so much for watching. As always, if you find this content helpful, smash that like and subscribe button to help the channel grow, turn on the notification bell, and check out all the links in the description down below. Remember, don't panic if you see your portfolio losing value, and if you have any questions, you can address them in the comments below. See you in the next video. Stay safe.